Hi, I'm Mitzi Sullivan with Facts, Figures, and Fallacies from the Front Line. And today I will be on the second of my three-part series. These are my top 3 tax strategies for W-2 earners. So the first one was setting up an HSA and using that HSA as a super Roth. And you can find a link to that in the description below. Today I'm going to be talking about my second favorite tax strategy. So once you have your HSA set up, the next thing you want to do is contribute to your IRA. So a lot of people feel like, well, my income level is too high, so I can't contribute to an IRA or I can't contribute to a Roth. And that's actually not the case. So today we're going to look at how to get that money in every single year. You've already got your HSA. Now you're going to get money into a Roth IRA every single year, regardless of your income level. You do need to have taxable income to contribute to an IRA. So if you've gotten your income down to 0, this won't work for you for this year. So if your income level is over $138,000 for single or $218,000 if you're married filing joint, and this will be for the tax year 2023, this current tax year. So if you don't qualify, if you're not eligible for a front door Roth, then you can do a backdoor Roth. And this is a loophole, surprisingly. It's been around for a long time, but a lot of people don't realize that this is available. So we have clients come to us every year and they say, oh, I make too much money, I can't contribute to a Roth. And that's not the case. So the way this works is you would first set up a brand new traditional IRA account, contribute your funds into that IRA account, $6,500 for 2023, or $7,500 if you're over the age of 55. That first step would just be getting after-tax contributions into a traditional IRA account. You don't qualify for the pre-tax, so these would be after-tax contributions. And then on day 2, you would convert those after-tax contributions to a Roth. And there's no tax consequence for doing that because you've put the money in after tax anyway. You've already paid the tax. So not to do this, you're missing out on that tax-free growth and tax-free distributions from that Roth account, and you've already paid the tax on it anyway. So that's why once you've set up your HSA, this is my second favorite tax saving strategy that most people that have earned income can take advantage of. One of the great things about the Roth IRA versus a traditional IRA is there are no required minimum distributions. So up until the date that you die, you can leave your money in a Roth IRA. Once you are deceased and you pass this Roth IRA onto your heirs, then they have 10 years to withdraw funds out of that account. In the meantime, that money is just sitting in there growing tax-free, and it will come out tax-free, even to your heirs. You can contribute to a Roth at any age. There's no age limit on how long you have to contribute to a Roth. So what we see with high-income earners, they will contribute to their Roth accounts every single year that they have taxable income, and they never touch the account. The high-income earners typically will put their funds in a self-directed account. So instead of earning, 8 or 10%, they're earning 15, 20, 30, 40% in a self-directed account, and that's how those accounts get to be so large. And then all that money comes out tax-free. So they may be earning $1 million a year, and then when they retire, they're in a 0% tax bracket. So this is a great strategy for high-income earners, and this is called the Backdoor Roth. One thing to remember with the Backdoor Roth is you are converting a traditional IRA account to a Roth IRA account. You're just doing it on the second day, and those are post after-tax funds that you're converting. If you have an existing IRA account, there are things that you have to do before you try this Backdoor Roth. So a lot of times you may have an IRA that you've forgotten about. One thing to keep in mind before you attempt a Backdoor Roth IRA is that if you have any other traditional IRA accounts open, those have to be converted first. And if you don't want to do traditional IRA to Roth conversions because there are taxes that will have to be paid on that, you can also move those other traditional IRA accounts into your existing 401k account. When you're looking at the IRA Roth conversion, The 401k accounts are not included in the calculation, and also inherited IRA accounts are not included in the calculation. So when you want to do a backdoor Roth IRA, make sure you don't have any existing IRA accounts. And if you do, any existing traditional IRA accounts. And if you do, those traditional accounts need to be converted before you do your backdoor Roth conversion. So you can either convert those traditional accounts into Roth accounts, maybe some, a little bit of at a time over the next couple of years, or 5 years or 10 years, whatever you want to do there. And if you're not ready to convert those over to a Roth, you can move those IRA accounts into your 401k account. So when you're doing your backdoor Roth, the calculation will not include inherited IRAs, and it will not include any funds that you have in a 401k. You just want to make sure you don't have any other existing IRA accounts that need to be converted before you can do a backdoor Roth conversion. A couple of great ideas that you can do with a backdoor Roth. Once you have those funds in your Roth account, you can combine your Roth IRA accounts, your Roth 401k account, your Roth HSA account, and invest. If you're self-directing, you can combine all of those accounts together to invest in an alternative asset. And that way, if you have something that you have an expertise in where you can get a better return than maybe you would get in the market, that's a great way to use a Roth IRA account. So when you get your 1099-R, it will say gross distribution $6,000, taxable distribution $6,000. If these were after-tax funds that were put in a traditional account and then immediately converted into a Roth IRA, make sure that your accountant knows that. Your accountant will file an 8606 on your 1040, and that will tell the IRS that these were after-tax contributions that have been converted to a Roth. And then another error that we see is people either forget about the fact that they have other traditional IRA accounts out there, or they don't realize that those have to be converted before you do a backdoor Roth. So make sure you tell your accountant about all of the IRAs that you have before you try to do this backdoor Roth. So as I mentioned, if you have other IRA accounts out there that you want to convert to a Roth account, we have a couple of tips for when's the best time to do those conversions. We'd like to see as much of your retirement income as possible in Roth accounts versus traditional accounts, but we wouldn't recommend just taking all your traditional accounts and just converting them all over to Roth, because you're going to pay tax on those. And you want to do that in a planned way so that you don't bump yourself up into a higher tax bracket. Sometimes you can have a really low income tax year. That's a great year to do the conversions. So let's look at a couple of things to keep in mind when you're doing your Roth conversion. So one great idea to do your tax conversions is when the stock market is low. So if you have traditional IRA, 401k accounts in a brokerage account, you're invested in the stock market, and the market drops and it's really low, maybe it's the end of the year and you're doing some tax loss harvesting. Another thing to keep in mind is that we are still under Trump's Tax Cuts and Jobs Act, so our tax rates are probably lower than they will be after 2026. We'll probably see those tax rates increase. So a lot of people are doing these traditional to Roth conversions over the next couple of years before the tax rates go up. And we don't know if they will go up, but we're just guessing that probably they will. You want to make sure that you don't convert into a higher tax bracket. So if you are in a 24% tax bracket, you would want to maximize all of your 24% bracket, but don't kick yourself up into the 32% bracket, then you're just paying a higher rate. Also keep in mind that when you retire, it's okay to have some traditional retirement income, because you'll have your standard or your itemized deductions that will eliminate some of that income. So it's not really necessary to convert all of your retirement savings accounts over to Roth. You can leave some in traditional. And the deadline for the conversion to do a Roth conversion is December 31st. So if you want to do a Backdoor Roth on April 15th. Make sure that all of your traditional IRA accounts have been converted by December 31st, either converted or maybe moved into a 401k. All of that needs to happen by December 31st. And then remember that converted funds are a little bit different from just an IRA Roth contribution in that you need to leave those funds in your Roth account for at least 5 years before you withdraw your contributions. And then when I say that the taxpayer has to have earned income, the spouse does not. So if you have enough earned income to maximize your IRA contribution and also your spouse's, that's fine. The spouse doesn't have to have separate earned income. And then keep in mind, if you can get your taxable income low enough, you can contribute to an IRA and get a saver's tax credit. So that would be where the IRS actually pays you to put money into your IRA. And there obviously will be some taxable income limitations on that. So just check that out and see if you're eligible. Okay, so that's it for my second favorite tax saving strategy. So don't forget to like our video and follow us on all of our social media accounts. And have a great day.